Bond traders no longer believe that central banks can control the long end of their own yield curves. And that disbelief just went global. So on Friday, May 15th, three bond markets on three different continents broke at the same time. The S&P at all-time highs in dollar terms is down 40% if you price it in gold since the start of 2022. So on Friday, May 15th, three bond markets on three different continents broke at the same time. The US 30-year hit its highest level since 2007, the UK 30-year levels not seen since 1998, and the Japanese hit an all-time record. Same day, same direction, same warning. The magnitude of what this could imply is being overlooked. By the end of the video, you're going to understand exactly what the bond market just said, why the Federal Reserve is now backed into a corner with two exits, neither of them a good choice, and the specific gold price that the math is pointing towards when all of this resolves. So let's get into it. So normally when bonds sell off in a panic, there's some sort of center of gravity. In 98, it was Russia. In 22, it was the UK Liz Truss budget. In 2008, it was Lehman. The bond market reprices around one distress signal and the rest of the world follows. This time, there's no center of gravity. The UK 10, the US, the German Bund, the Italian, the French, the Greek, the Japanese, every developed sovereign bond market on the screen moved in the same direction at the same time on the same day. So when that happens, the cause isn't country specific, it is systemic and it's a global issue. Here's the simplest way to put it. Bond traders no longer believe that central banks can control the long end of their own yield curves. And that disbelief just went global. So now to understand why this matters, what comes next is you need to see the squeeze that our Federal Reserve is currently in, because there's two giant forces that are literally crushing them from opposite directions. And they can't fight both at the same time. So let me show you. So the first pressure is inflation. Inflation is about to accelerate violently. 2 days before the bond markets broke, on Wednesday, May 13th, the Bureau of Labor Statistics released the April Producer Price Index. On an annual basis, the PPI for final demand advanced 6% from April 2025 to April 2026. That is the biggest 12-month increase since December of 22. The monthly number came in at 1.4%, almost 3 times what economists had expected. Now, here's why PPI matters. Producer prices are what businesses pay. Consumer prices, reported through CPI, are what you and I pay. So producer costs lead consumer costs by about a few months, because eventually those higher input costs get passed down the chain to the grocery store, to the gas pump, to your auto repair shop. But PPI at 6% is the bond market's preview of what CPI is about to look like. And it gets worse. The Strait of Hormuz is closed. Global fuel inventories are heading for critically low levels. ConocoPhillips and Chevron CEOs both said critical oil shortages are coming. The USDA just projected the smallest U.S. wheat harvest since 1972. China has effectively weaponized sulfuric acid, which the Wall Street Journal points out is the most consumed chemical on the planet. So if you're not familiar, sulfuric acid is crucial for manufacturing batteries, clothing, fertilizers. It's also used to treat drinking water, purify petroleum, and produce some metals and computer chips. So even Treasury Secretary Bessent admitted this week that the Fed is going to get, quote, 1 or 2 hot inflation numbers. That's the Treasury Secretary preparing the public for what is coming. So picture it this way. Imagine you run a household. Your grocery bill just went up 20%. Your gas bill is up 30%. Your electric bill is rising. Now variable rate interest on your credit card just hiked your interest rate because banks think that you're stretched. So you got 2 options. Option 1, you slash spending to the bone, or you ask your boss to print you a raise out of thin air. That is the Fed right now, except the boss is them. So it's a bit of a conundrum. Pressure number 2, the bond market is breaking. The other side of the squeeze is the actual debt math. Gross U.S. federal debt just crossed $39 trillion. Debt to GDP is around 123% when you add in debt held by the public plus obligations like Social Security, Medicare, etc. And here's the kicker. The United States now paying over $1 trillion a year just on interest alone. That is more than the entire defense budget. So macro analyst Luke Groman, one of the most brilliant minds in the industry, I think, has pointed out repeatedly that we've seen empirically since 2019 that the U.S. economy and the bond market simply cannot function with a 10-year above the 4.4, 4.5 level, which he pointed to the fact that when we get above that, some kind of headline always comes in. You'll see, a headline in the news opening the Strait. While I am recording this, that mark, 4.66, I think, just was crossed. Every time it pushes through that level, something breaks. Regional banks, commercial real estate, the repo market, something. So here's the squeeze in plain English. Inflation is going to force yields higher, but the U.S. fiscal situation cannot survive higher yields. The Fed is being pulled apart by two forces and demand opposite responses. So this is what brings us to the choice they've been trying to avoid for years, the choice that they can no longer postpone. So the Fed has two options. Option one is let the bond market do its thing. Yields rise to whatever level that the market demands. The dollar stays strong. Treasury auctions clear because real returns are attractive again. It sounds reasonable, except that the government's interest bill explodes. Regional banks already sitting on massive unrealized losses on their bond portfolios start falling one by one. You got commercial real estate, leveraged corporate debt, private equity. Anything that depends on cheap money is going to implode. This is literally the equivalent of cutting the brake line to save the engine. Yeah, you stop the runaway car, but eventually everyone inside goes through the windshield. Option two, you save the bond market. The Fed prints dollars to buy treasuries and they cap yields wherever they want them. Government stays solvent in nominal terms. The auctions get bought and the immediate crisis is averted, but the dollar gets debased even further. So every new dollar created out of thin air to buy bonds means every existing dollar represents a smaller share of the total pie. Inflation that's already running hot becomes a systemic, permanent feature in our economy. Now, this is fixing a leaking boat by drilling more holes to let the water out. So you haven't really fixed anything. You've just made sure it sinks slower while everyone applauds your decisive action. And I think here's the thing that most people are missing. The Fed has already chosen. They've been doing it since last fall. They just haven't admitted it. No central banker wants to stand at a podium and say, yeah, we're going to monetize the debt. Instead, they call it reserve management, standing repo facility expansion, treasury buybacks. Same operation, just a different label. It's QE, not QE. Now, at this point, half of the macro Twitter crowd will tell you, don't worry, we'll just run Japan's playbook. So Japan ran this exact playbook for about 30 years and the wheels never fell off. So we'll just stagnate sideways for a generation or two and everything will be fine. Here's why that's what macro analyst James Lavish calls the most dangerous comfort blanket in finance. In a recent piece, he stated that why the United States can't do what Japan did. So this is credit to him for the framework that I'm about to lay out. But reason number one is who actually owns the bonds in Japan. About 93% of all long-term Japanese government bonds are held domestically. Japanese pension funds, Japanese banks, Japanese retail savers, the Bank of Japan itself, they're all captive audience, regulated, mandated. So when the BOJ suppresses yields, that base eats the loss because they have nowhere else to go. In the United States, roughly 1 out of every 4 treasury dollars is held by a foreign holder. Foreign central banks, sovereign wealth funds, pensions, asset managers. These holders are not captive. They can rotate into whatever they want to. European debt, gold, Bitcoin, emerging markets. And if you continue to suppress their yield while inflation is eating at the return, they are going to do that. Reason number two, the United States is a debtor nation. Japan is the world's largest creditor nation. They own more foreign assets than they owe to the rest of the world. So when the yen weakens, their foreign holdings become more valuable in yen terms. The country has a built-in shock absorber. So the United States is the exact opposite. We're the largest debtor nation in human history. We owe more to foreigners than we earn from them every single year for decades. When the dollar weakens, there's no offsetting cushion. So it's just pure imported inflation, pure loss. Now, we are the world's reserve currency, so we're not going to blow up like an emerging market debtor nation, but we cannot force sovereign nations or sovereign institutions to buy our debt. Reason number 3, the inflation backdrop. This is the killer. So Japan suppressed bond yields during 30 years of structural deflation. Prices were flat or falling. So a 0% bond yield in a deflationary environment, that's actually a positive real return. It's not great, but it's not destructive. The US is being asked to suppress yields with inflation running above 3% and accelerating fast. A 4% bond yield against a 6% inflation is a negative 2% real return. You're losing purchasing power every single year just for holding the asset. Capital that has options will definitely find them. Reason number 4 is the reserve currency amplification. When Japan debased the yen, only people doing business with Japan had to react. Maybe a few percent of the global capital flows. When the Fed debases the dollar, every central bank, every reserve manager, every multinational corporation, every commodity trader on the planet has to react in real time because every reserve manager on earth is holding the asset that is being debased. So the dollar's reserve status, the thing that we're told is America's superpower, actually amplifies the damage of debasement, not protects against it in this sense. So it's the same trap, completely different plumbing. Japan got a slow generation of stagnation. We don't have that runway, not even close. So if the pressure can't dissipate through or into deflation, and it can't be absorbed by the captive domestic base, it can't live in the suppressed real yields because of already persistent inflation, and the asset under stress is held by every major reserve manager on earth, where does it have to go? The currency. That's the only adjustment valve left. Watch the flywheel. The Fed prints to suppress yields, the dollar supply expands, inflation therefore rises, real yields will go more negative, so you have foreign holders having to sell because they're not going to hold on to negative yields. The Fed has to print even more to fill the gap, and the loop, it accelerates, that gold is designed for. So this is exactly the dynamic that gold and even Bitcoin were designed for. These are assets that the Federal Reserve can't print. They're assets whose supply is fixed or they grow at a schedule that no politician can change. And history rhymes here, and it rhymes hard. In 1971, Nixon closes the gold window because the U.S. could not honor its commitments. In 1996, the U.K. has to go to the IMF. It's the largest bailout in history because the pound collapsed. 22, Liz Truss tries mini budget and the UK gilt market breaks in 48 hours. 25, the US Treasury extends 20 billion lifeline to Argentina because their peso is in a free fall. Every single time the bond market and the currency stop cooperating, and every single time the currency is where the adjustment finally lands. Now, at this point, if you're smart, you're asking the obvious question. If the dollar is the release valve and gold is the receiving asset, how high does gold have to actually go in order for this to all make sense? And this is where Luke Groman has what I would say is the cleanest framework for predicting the math. And the math is going to surprise you. The metric is called the gold coverage ratio. So you take the market value of the gold the U.S. Treasury officially holds, that's 261.5 million troy ounces, which has been basically static since the 70s. You divide it by the total foreign held U.S. Treasury debt. The result tells you what percentage of America's foreign debt is collateralized by gold. Now, why does this matter? Because historically, every time the dollar has gone through a credibility crisis, gold has been the asset that restored credibility by recollateralizing the system. It is the mechanism. So let's run the numbers as of today. U.S. gold holdings, 261.5 million ounces. Gold price right now, roughly $45.40 an ounce. That gives you a gold hoard worth roughly $1.19 trillion. Foreign held U.S. treasuries are approximately $9 trillion. So the gold coverage ratio today is about 13%. Now, here's where it gets interesting. Historical benchmarks. Through the entire 1970s and early 80s, the ratio swung between 40% and around 130%. And that range is exactly what actually restored the dollar credibility after Nixon closed the gold window in 71. Today, like I said, we are at 13%. Gold has to rise until the U.S. official gold collateralizes somewhere between 40 and 60% of foreign held debt for the dollar system to stabilize. Not 100%, not 135, just 40 to 60. That is where we've seen the standard range. So what does this imply for the price of gold? Solve the math backwards. To hit 40%, the coverage at the current foreign debt levels, gold needs to be around $14,000 an ounce. To hit 60%, you have a $20,000 gold price. To get back to full collateralization, you're looking at north of 35,000. And to match the 1980 peak, you're looking at closer to $46,000 an ounce. Now, listen, I want to be clear. This is not something that he is saying will happen. He's not saying gold's going to $1 billion. He is just pointing out that historically, this is a mechanism that has been observed. So either the U.S. devalues against gold to restore credibility, or it has to do something equally disruptive like massive fiscal consolidation, austerity, or finding trillions of new treasury demand from somewhere. Given the political reality, which path do you think gets chosen? Like I said, this is a framework, not a prediction. Gold does not have to reprice this way tomorrow. This is his estimates given the cycle that we're in. But the math eventually forces a resolution. Either gold goes up or something else gives. Besant has floated the idea of a gold revaluation. Or the U.S. Treasury still carries gold on its books at $42.22 an ounce from like 1973. Mark to market, and the federal government overnight gets a balance sheet adjustment worth over about $1 trillion. Now, this is not to scare anyone. It's to make sure that you actually see what's happening so that you can make informed decisions for yourself and for your family. But every time in history that a major government has been forced into a corner, the people who understand the mechanics ahead of time get to protect their purchasing power. The people who trust the official narrative lost generations of savings. And that's just the truth. So 3 things to take with you today. Number 1, the Fed is not going to announce what they're doing. I always say, watch what they do, not what they say. And it's very obvious, not only what our Fed is doing, but what central banks across the world are doing. The labels will change on our side, but the mechanics won't. Number 2, the dollar is the release valve. Every asset priced in dollars is being measured with a shrinking ruler. The S&P at all-time highs in dollar terms is down 40% if you price it in gold since the start of 2022. That's not opinion, that is the chart. Number 3, assets the Fed cannot print. Gold, silver, productive real estate, productive businesses, Bitcoin. These are the historical answer when sovereigns reach the point that we are at right now. And the math, based on his framework, says that we're nowhere near done. We're at a 13% coverage. History suggests that 40 to 60 is the destination. And I think that's a long way from here, meaning we're going to get there during this cycle. This is not new. This has happened before, and it will happen again. We did just have warning from Hank Paulson, who literally ran the U.S. Treasury through the 2008 financial crisis. He wrote in the most literal sense, the modern break the glass playbook for a financial system that is in duress, something that I actually talked about in one of our last couple videos. So if you got value out of this, hit the like button. It helps the channel reach more people that need to hear this. Subscribe to the channel if you haven't already, because we're going to be tracking this every step of the way. And drop a comment below. Let us know where you think gold runs to by the end of the cycle. We'll see you next time.